Look at the sheer scale of a project like this. Building massive factories, expanding global supply chains, or developing new technologies requires millions, sometimes billions of dollars in upfront capital. It is a price tag far too heavy for any single person to carry alone. You might wonder why a company doesn't simply borrow that cash. While banks can provide funding, taking out a massive loan saddles a growing business with crushing interest payments. They are forced to pay that money back, plus a premium, before they even have a chance to turn a profit. Instead of taking on rigid corporate debt, founders have a second option. They can raise cash by dividing their business into pieces and selling those pieces to outside investors. The money they raise this way doesn't require monthly interest payments, and it never has to be paid back. This is the essence of a stock. Each share represents a legally binding claim to a portion of a company's assets and future earnings. When you buy one, you are purchasing fractional ownership of a real-world business. By utilizing this legal mechanism, total strangers can pool their individual resources together to fund and build corporate entities far larger than any single human could construct. Let's scale this down to see how the math actually works. Imagine an entrepreneur wants to launch a local retail store. She needs $100,000 to get the doors open, but she only has $50,000 saved up. This diagram shows how she bridges the gap. The entire $100,000 business valuation is split into 10 equal blocks, or shares. Because she provides half the cash, she keeps 5 of those shares. A new investor decides to buy just one of the remaining shares for $10,000, giving them exactly 10% ownership. Now assume the business is highly successful. Over 5 years, the total value of the company grows from $100,000 to $300,000. Because the investor holds a 10% stake, their single $10,000 share scales right alongside the business to $30,000. But the math works in reverse as well. If the total valuation drops to $80,000, the investor's 10% slice compresses with it. Their share drops to $8,000, a direct loss of their initial capital. Sharing the exact same upside and the exact same downside as the company itself is the core engine that drives all stock market investing. When a successful local company outgrows private investors and decides to expand globally, it requires massive amounts of capital. To get it, the company will go public, listing its shares for anyone in the world to buy. To facilitate millions of transactions, they rely on a stock exchange, a centralized marketplace built to connect buyers and sellers at an industrial scale. Over time, the physical shouting on the trading floor was replaced by electronic terminals, laying the groundwork for the instantaneous digital networks we use today. Before digitization, investors received tangible proof of their purchase. This physical certificate is a literal contract of fractional ownership, explicitly detailing the exact number of shares held by the investor and the specific class of stock they purchased. The modern stock exchange functions as a hyper-efficient distribution network. It instantly allocates capital to businesses that need it, while transferring ownership to the individuals providing the cash. As companies grow within this megastructure, they issue different flavors of ownership to attract different types of investors. The primary material they issue is known as common stock. Holding common stock comes with 2 main perks. First, it grants you voting rights on major company decisions, giving you 1 vote for every share you hold. Second, it offers the highest potential for massive value growth over time if the business succeeds. The trade-off for that growth is financial risk. If the company fails and goes bankrupt, common stockholders are the last group in line to get their money back after all debts are settled. The alternative is preferred stock. Investors who buy preferred stock sacrifice their voting power. In exchange, they receive a guaranteed, reliable slice of the company's profits, paid out as a fixed dividend, and they stand further ahead in line during bankruptcy. Investors pick between these 2 structures based on their personal risk tolerance. You buy common stock for aggressive, long-term growth, and you buy preferred stock for a steady, reliable income. All of this raises one practical question. Why would an everyday individual expose their hard-earned savings to this volatile market instead of leaving it perfectly safe in a bank? This chart visualizes the historical difference in returns. A traditional bank account might offer a predictable 1 to 2% in annual interest, but the overall stock market has historically returned an average of 7 to 10% per year over the long term. Notice the extreme volatility of that higher growth line. Market crashes, sudden drops, and economic recessions are simply the required toll investors pay in exchange for long-term wealth generation. To navigate that volatility, investors rely on strategy. They mitigate risk by researching companies they actually understand, and they diversify their money across multiple sectors to ensure a single failing business doesn't wipe out their entire portfolio. By accepting the inherent risks of fractional ownership, everyday people are able to fuel the ongoing advancement of the modern world and position themselves to profit directly from human progress.